Welcome to a video on the basics of support and resistance. Simply stated, support and resistance are respective price levels at which price stops going down or up. A price in any market is one at which buyers and sellers have agreed upon fair value. If more buyers think that the price is fair or cheap, they will attempt to buy. This in turn raises demand and prices rise. And as prices rise, buyers become less active and sellers become more active. And at some point, buyer and seller activity will balance out again, and this price becomes resistance. So what are supply and demand in the markets? In any marketplace, supply and demand rule. Let's say a government study on the benefits of a certain wonder product reports that it is 100% safe and effective. High-profile celebrities endorse it, and there are no competitive products anywhere. Does this mean the maker of the product will see its profits rise? Well, the answer is maybe. Profits will rise if and only if sales are made. If there is no demand for the product at the price at which it is offered, there will be no sales. The same reasoning holds true in the financial and commodity markets. If the price of a stock or commodity is too high, there will be no demand and no buyers. If the price is too low, there will be too much demand relative to supply, and hence too many buyers. In the example, the maker of the wonder product may have a great product that will make lots of profits, but a company is not its stock. Demand for the stock is not demand for the product that it makes. Only an imbalance in buyers and over sellers makes the price rise. Perceptions are reality. When a market trades between support and resistance, buyers and sellers are adjusting their actions according to what each perceives as being fair market value. At support, demand has increased to a point where it balances out supply. Conversely, at resistance, demand has decreased, or supply has increased, to a point where it again balances. And these balance points are different at each price level. As with rumors and advertising, the more times we hear something, the more we accept it. In the markets, the more times the market touches a support or resistance level, the more important that level will be perceived. Buyers and sellers become accustomed to acting in a certain way at each level. Unless something happens, and that's usually news, that causes perceived value to change, support and resistance levels will contain the market. Let's use an example in the stock market. Let's say resistance for the stock of XYZ company is at 50. The market bounces around below 50 for several weeks until it finally pushes above that price. Whether these new buyers acted on earnings news, an inflation report, or a signal from a trading system does not matter. The charts show a breakout above resistance, indicating a new level of higher demand and a lower level of supply. An interesting thing now happens. If the market trades back down to 50, buyers who missed the earlier breakout will see their second chance to get in. The market bounces up off the 50 level, which has now become support. And why is it support? The reason is that the general level of valuation perception in the market has changed. What was once considered too high is now considered too low based on these new levels of supply and demand. Let's say supply and demand balance out again at 55. Every time the market moves to 55, sellers who missed their chance to unload their stock before will become active. They fear that they will never see that price again at the next pullback, after the next pullback. Again at 50, the greedies see that they can pick up more shares before it goes up again. So let's look at the chart. This is a weekly chart of International Business Machines, IBM or Big Blue, and it starts in late 2008. But in 2010, you can see the highlighted area. It shows how the stock traded between support at 121.40 and resistance at 133.40. Something happened in September that changed people's perceptions, and what was once expensive, the resistance level, was now thought to be cheap. The stock broke out to the upside, and that's right about here. Support and resistance levels often become relevant again in the future. If the stock is halted at the 50 level enough times, both buyers and sellers become used to acting a certain way at that price. And while an individual may not recall what he did in the past, the market, which is the collective wisdom of everybody, sure does. Let's move on to another chart. This is Whole Foods market, and as we can see, between 2013 and 2015, it had a rough couple of years. On its way higher in mid-2013, it established a support level at 51, as we can see on the chart. After peaking and heading back down, it found support once again at 51, and not only on one occasion. This level's importance grew tremendously. When support broke in April 2014, the stock hesitated and ran up to touch 51 one more time. Late sellers got their chance to sell, and supply swelled. Support and resistance levels often become relevant again in the future. If a stock is halted at the 50 level enough times, both buyers and sellers become used to it, as we said before. And while an individual may not recall what happened, I can't say this too many times, the market, the collective wisdom of everybody, sure does. A smaller support level was established in April and May at 47.85. After the stock's collapse and recovery, where did it stall? In November 2014, it ran into resistance at 47.85. After the rally resumed, it peaked and then started heading lower. And where did the stock find temporary support in April 2015? You guessed it, once again at 47.85. It broke that level and collapsed one more time. So, the unasked question is, why doesn't the market jump immediately from one equilibrium level to the next? For example, earnings come out, they're blockbuster, why wouldn't the stock just jump up to the next level? And the answer is that information flow is not perfect, and people do not all reach the same conclusions at the same time. As the masses slowly jump on board a trend or breakout, the momentum builds until price reaches levels that exhaust excess supply or excess demand. And then these are then called support and resistance.